We're going to get cracking in a moment, but before we do, this is an important announcement. The information contained in this podcast is general in nature and does not take into account your personal situation. We don't guarantee the quality of the wine or the banter contained in this content. You should consider whether the information is appropriate for your needs and your daily intake. And where appropriate, seek professional advice from a financial advisor, accountant, bottle shop assistant, or relevant qualified professional. Matters referred to in this podcast are of general nature only, and for those of drinking age, and should not be relied upon in place of appropriate personal advice or the odd glass of wine on a Friday.
To make sure you get the most out of wealth, wine and wisdom, folks, please follow the house rules. Don't be a wallflower, get involved in the chat. We love to have some questions, feedback, and a little bit of commentary along the way. You give us energy, we'll have a good time. Make sure you pour yourself a glass of something wet to wet the whistle. Make sure you get the banter flowing as well. Doesn't matter what you're drinking, whether it's wine, our favourite, beer, coffee, maybe it's a cup of tea, water, or even juice. Keep that good energy flowing, folks. There's some house rules. If you don't put your name down, we don't know who you are, you're not coming in. Don't spam or advertise. This is our little game of cricket. This is all about debriefing the week, folks. What's going on out there in the world, and hopefully get you some sanity, maybe a bit of a chuckle at the end of the week, so we can all be on the same page and keep moving forward. Make sure you respect your fellow patrons, because we don't let any old muck in this place. And most of all, have some fun and enjoy this episode of Wealth, Wine and Wisdom. Sam Saggers.
I tell you what, that intro's bloody cracking. I feel like I'm actually in a bar with you. That's amazing. And yes, I'm not Andy Fenton, everyone. The great man is off doing some business, but I'm filling in. I felt like I was filling in the other night at mentoring too. Tab wasn't there.
Oh, mate, I think it's been one of those months where people have been MIA for whatever reason. But thanks for joining me, mate. It's great to have you.
That's good. I really like that little guitar riff on the way in. It was a really good. Yeah, wow, I'm in a jazz bar or something talking about economics. This is, and I've got the wine, so hey, happy Friday.
You're all set up. Well, we've got a few people already logged in, Sam, so let's say a quick hello to a few of them. Alexis, good to have you here. What are you drinking tonight, Alexis? You got a bit of a mixer there. You got wine, spirits and beer going on. It could be good.
I've always liked that name, Alexis.
Mate, Bryce is grabbing a wine.
That machine came along and sort of ruined the name, didn't it?
It did.
Alexis, turn on the lights.
We've got Kumi here. Hey, this is first time joining. Well, there you go, all the way from Bangalore. You normally live in Perth. Well, fantastic. Great to have you on the show today. We do have a few visitors flying by. Well, in the mornings, Sam, I have a regular from Florida. Kevin.
You're right. Wow. Well, Bangalore, there you go. The old tuning in from the subcontinent. Wow, it's unbelievable.
Well, it's good to see a mix of people. What time is it over there, Kumi? Let us know as we go. A few people have been able to drop by to grab a live, which is all. Got the hard tea, vodka and chili chocolate tea. That is pretty good. Kumi's flying planes around in different places and spaces. So fantastic. Well, listen, 11:45 a.m. So there you go. That's not too bad. It's not too late at night. Well, welcome everyone. Great to see everybody here. I'll do the quick, set the scene for what we're up to today, Sam. Normally we sort of say, hey, I've been doing property 20 years. Andy's been doing finance and economics 20 years, but you've been doing property longer than me. It'd be 30 years. Why don't you give everyone the 2-second helicopter view of Sam Saggers, the property extraordinaire, joining me today. We're doubling down on real estate today, folks.
Oh, okay. Yeah, sure. Well, my background, I did a basically a diploma in property. It was a 4-year process, and got into real estate as soon as I left school, and basically, became an investor in my early years, and pursued that. Met up with this crazy looking fellow. He's turning 50 on the weekend, by the way, everyone. So
Big 5-0.
big 5-0. Is that a scary proposition?
Well, it doesn't feel like that. So maybe when I get there, I'll be different. But we shall see.
Well, have you got anything planned? Are you going to have a big shindig or anything?
Nothing big. Just going to have a family get together. So I'm a bit kind of. I don't really like attention in that way, Sags, to be honest.
Yeah, birthday parties can be a bit that way.
Yeah.
But anyway, we had our 20th, business 20th, just a month ago. That was kind of like a big party for everything, wasn't it?
I think that was. I think I'll take that as the big party myself.
No, well, yeah, my background's really just real estate. I've worked in the investment space for 30 years. I've written a few books. I've even spoken at guest lecturing at universities and things like that on urban behavioural economics. And yeah, really my specialty is understanding sort of housing market fundamentals. So yeah, it's crazy times, but it's always crazy.
Mate, certainly crazy the last few years. And if you have any questions, ladies and gents, put them in the chat. As you guys already know, if you're regular, some new, some regular, we've got a couple of sections of the show. Usually in the afternoon, we have a glass of wine and get a little bit warmed up. The first section is usually sort of what we call Decant the Week, which is, hey, what's been going on in the news? We'll have a little look at that in a second. We'll have a section about the number one menace. There's a number one menace, but there's a section of three of them. It's the media, it's the politicians, and the banks. Usually, the number one eroders or menaces when it comes to wealth. And the last part, if we've got something in the tank, we might do a little bit of, hey, here's something you should know, and we call that the perfect pairing. Hey, there's a problem, Sam, and there might be a solution, as we go. So great to see everyone here, and good to see some people hitting hard liquor early in the afternoon. Porty, good to see you, brother.
Tequila.
Thanks.
I don't mind a tequila. I don't mind a little dark tequila on ice.
Sammy, what's your drink that you drank way too much of and you'll never drink again? Tequila was mine.
Well, I think vodka. Yeah, I'm not a vodka guy.
Vodka. So Sam doesn't drink vodka, and Porty, tequila for me. If I smell it, oh, no good. When I was 21, I had way too much. There you go. All right, well, let's do it, folks. Let's get into the show, and let's kick it off with our first part of the show, which is Decant the Week. We'll be right back after this. Well, Sammy, make sure you jump in whenever you feel you've got an opinion on this. I know you will have, but check this out, folks. This is just from 24th of Feb today, 2:45. The great housing crash, Sam. The great housing crash has stalled.
Well, I'll tell you what, it's interesting, isn't it? The media will jump on anything as soon as they catch wind of something, they'll create a headline. But I tell you what, this was always going to be a mid-cycle slump. It was never going to be a crash. Crash is a pretty crazy word for where we're at the moment. It really is that sort of mid-cycle slump while everyone gets their head around to really get started again. And so, yeah, it's interesting though. They're starting to see what's underneath the hood of this thing, and it's really, a terrible undersupply, and everyone holding on to their real estate.
Yeah, well, the idea that the market's crashing certainly isn't supported by any of the data, Sam. No matter which way you slice it, folks listening in, if you go, all right, well, let's start at a 0 point. Let's go, Jan 2020. If you have a look at this national wise, the average house price or home price growth, 30% up from 3 years ago. Now, I don't know about you. I wouldn't be calling this a crash, folks. There doesn't look like any crashes going on here. And if you have a look at, Brisbane and Adelaide, Sam, 40% up in the last 3 years. Those two towns, we had our eyes on for a while. And some adjustment in, the big kahunas when it comes to sort of Melbourne and Sydney. But maybe we'll dine out a little bit on Melbourne in a minute, because you and I have been talking about this for a while when it comes to, hey, why has Melbourne had, a little bit harder time of it when it comes to the property market? But certainly I don't see any crash there, folks. I don't know if anyone sees a crash in that data. Oh, well, let's go check someone else. We have a look at CoreLogic and Domain. Here's the chart. Depending on how you chart your data, can always show you some interesting things. But the house price growth over the last 3 decades. Well, Sam, we talk about this often. You want to buy a property and keep it because it takes time. You and I were just talking about 18-year real estate cycles, and I was talking about 15, 18. This is what it's about, right?
Yeah, well, absolutely. And that sort of positioning us to be in the mid-cycle kind of slump at the moment, because the cycle hasn't finished. Actually, the cycle is due to finish in 2026, starting again in 2027. And the next 18-year cycle will go from 27 to 45, which is crazy to think. But you can actually see on those slides where just about where the last cycle started, where it's in 1994.
Yeah.
And if you go, it actually started in 1989 and it finishes in 2007.
Yeah, that cycle there.
That's one cycle, and you can see basically a cycle starts with recovery.
Yeah.
So you'll see the first half of that cycle is sort of sideways to basically sideways growth, and then you get this accelerated growth phase. And so now we're in this next cycle, and it's a cycle of 2 halves. So you actually see the cycle reach a point in 2019 where the first half of the current cycle is, and then we've got the remaining about 7 years. That's second half of the cycle is from roughly sort of 2019 to 2026. And really the concept, if you like, is you take macroeconomics, business economics, and fiscal economics and apply it to the property market. And the theory is that because there is always going to be demand for property, and because governments on OECD countries are always trying to push growth in their economies, you'll always get property growth. And it's roughly out of 18 years, you'll get 14 good years and 4 bad.
4 bad.
And looking at that slide you brought up before, because it actually had 4 bad years on it, the Dr. Andrew Wilson one.
Yeah, well, I mean, this is the thing. One of the things, Sam, before we move on to that one, I'll just quickly sort of show this. This is the cash rate, folks, over that period of time too. So you can say, there was a comment, Sam, interest rates have gone down, so that's why property prices have gone up. And by and large, that has a factor, right? That certainly has a factor. Makes it easier for people to borrow money, and most people don't spend within their budgets, right? They always spend a bit more. Bit of a shout out to Ben. How are you, mate? Good to see you. Ben, we need to get together. I haven't seen you for months, mate. Hope you're well. Back at you. So, Sam, you and I talked about, okay, well, what happens to the real estate market now? Let's say, all ships rise. What's the saying? All boats go up on a rising tide or something, right? Or whatever it is.
Yeah.
But, when the tide goes out, let's say money's more expensive, where's the discerning dollars go? Like, how does growth accelerate, continue, into the future? I don't think it's expensive money anyway into the future, but you and I have talked about this a few times, when it comes to flight to quality when it comes to real estate. Flight to quality real estate wins.
Yeah, oh, absolutely. I mean, we're already seeing that now with where rents are headed on flight to quality properties. I mean, yeah, I'll show you an email I got just today, which is just, it'll blow people's minds as to how much rent is going up for the right real estate. Absolutely skyrocketing.
Mate.
And I think we've just got to understand, if you go back to your sort of previous slide where you saw the economics of two cycles, actually, if you go from sort of basically 1989, which isn't on there, but goes up to 2007, you had money change or morph twice. You had the deregulation of banks in the 90s, and then you had the mining boom one, which really pushed up wages. What that did was accelerate house prices. And then in the current cycle, you've seen, obviously, it really run off the back of low interest rates. And of course, that's led to the asset values climbing again. The next version, or the next cycle, 27 to 2045, is all about the intergenerational wealth transfer. So all that money you and Andy talk about, 6.1 trillion at the top of the funnel.
Yeah.
Once that's released, my God, that's going to do some buying. I tell you what, that's going to really, because you think about it, right? COVID, the government here in Australia pumped about $1 trillion into the economy.
Yeah, I've got a stat on that one actually down here, but like
we're talking 6.1 trillion.
6.1 trillion.
As baby boomers basically reach life expectancy and pass on that wealth. So, because obviously it's quite often hard to fathom that an $800,000 property today can become 1.6.
Yes.
Or 1.6 can become 3.2. And the same thing was happening back in 1989. It was like,
I remember you and me having a chat. It's over, Jace. It's over.
Yeah.
200. We busted through 200,000, mate. It's not going to happen. We might as well shut up shop, right?
Yeah. Yeah.
So
yeah, it's just the way it works. And really, it's financial engineering. It's the government that commands the economy, and obviously they make it harder in some places and loosen it up in others. And the theory of the 18-year cycle is just you're going to get a push me, pull me effect from government, because ultimately government needs houses built.
Yeah.
And puts money into that part of the puzzle. So,
well, I mean, the Australian government's not a very, it doesn't play much outside the lines of property, mining, and banks and farming. Really, at the end of the day, like they're the big drivers. But we do. We've got an actual special guest. We might bring him on. He's flying by just to say hello, Fenton.
My day is done. My day is done.
No, I thought I'd just fly in and make sure that you guys are behaving or misbehaving.
Well, we're trying to do that, Fenton.
And when things were getting harder and looser and push me and pull me, I was thinking, oh my God, this has really gone down the toilet.
Well, mate, you've made it. It's good. Have you got the wine? That is the question.
Or are you being healthy and behaving down there, Fenton? That's what's going on. Tell everyone where you are. You're down in Sydney at Nissi, Nail It and Scale It training with the K2 community and Kerwin Rae. Few of the listeners will know that.
Yep, day one of Nail It and Scale It with Kerwin Rae. We've got a great crowd down here, fully packed out the Wentworth. Just happens to be Mardi Gras as well. I was wondering why the prices of flights and hotels were so astronomically expensive. So I'm tipping I'm not going to get too much sleep tonight. Not because I'll be doing anything, but I'm assuming that there'll be a lot of raucous behaviour, floats, partying, and all of those sorts of things. So Sydney is alive, but it's great down here. A lot of business owners really enthusiastic, positive outlooks on the future, and as we know, they're the backbone of our society. And mate, it's great coming into this straight off a wonderful event with you.
Mate, we did have a nice time there up in Brizzy. If there's any of the exit planners listening in, give us a shout out. But I know we've got a few of the regulars online now, Andy. But mate, while you're here, Sam was talking about that big chunk of the most wealthy Australians ever in history about to transfer over this next decade. $6 trillion worth of wealth and assets. You and I talk about it often when it comes to business owners. Yep, we got someone in here. Yep, hello. It's a good weekend. What do you see in that space with business owners and the next decade or so? Like, that transfer of money is going to flow in pretty crazy places. Australia loves its real estate, but what do you reckon around the share market? I mean, we've got one of the wealthiest or the most the largest funds, pension funds, super funds in the world. I think is number 3 in the world, or it could be up there. That's going to transfer towards assets. What's your spin on it?
I reckon it's going to be interesting because when we look at it demographically, an aging population is a very bad thing for an economy, and that's something that's going to be very challenging for especially China, because I think China's about to put its wheels back on. So there's a consumption story that will probably kick on in China, and you'll hear more about that probably over the next 6-12 months. But their longer term, as is Japan's, one of the biggest issues is that their ratio of new children being born is very low, and when that drops below 2, effectively each partnership having 2 children, that stabilizes the economy. And you need the young to pay for the old, right? And now I know we're Australians, we're not Italian, or there's many Italians in Australia, but the Italians and the Greeks tend to be a little bit better at taking care of their parents. There's a bit of a view in Australia, it's like, oh, those old bastards, just ship them off. But
get rid of them.
But get rid of them. The problem is we get rid of them into a highly subsidised environment at the moment. So the age pension, age care, all of these areas. So
money. Yeah.
So I think that it'll be it. I don't have a firm view on it as yet. The things that I'm kind of throwing around in my head is, yes, there's going to be massive asset transfer. I think Sammy was talking about, there's certain thresholds that you guys have seen real estate it's almost like a glass ceiling until it's not. And at the moment in Australia, 8,000 is kind of the glass ceiling here. When we see those transferences start to happen, those ceilings will be decimated. So, 2 things. We've got strong inflation at the moment, and everything rises to inflation unless one thing happens, which is deflation. And deflation is sort of, the governments try and make sure that doesn't happen. So they manufacture the economy.
Yep. Well,
and so we've seen a rapid increase.
Andy. Yeah, that's what I was saying the other day. Like, inflation and high interest rates at the moment is actually, like, if you think about it as a real estate investor, it's actually our best friend right now because our rents are skyrocketing. And I can tell you, when your rents go up, you're not going to drop them down when the interest rates finally go down and inflation's under control, folks, right? Now, tell me in the chat right now, give me a yes or a no. Anyone going to drop their rent $100 after inflation and the interest rates get under control?
Yeah, well, I think inflation's almost pushing people to a financial like finish line. Like, rents are going up so hard. You're right. If it deflates, people aren't putting their rents down as much as they've gone up. So you're absolutely, if you own assets now like real estate, which has pricing power in the rent, I absolutely think you're going to be better off down the track for sure.
You're in the driver's seat. Sonia's saying, nah, not happening. Not happening.
Yeah, look, let me just,
why would you?
I'll quickly show you. This is from my property manager today. Quickly show you.
You need to share your screen, Sammy.
Sometimes I think people think we're bullshitting. We're not. Can you guys see that?
Yep.
Yep.
And I blocked
got
out
it.
people's names because I didn't want to have them televised. But hey, confirming that a lengthy conversation with blah 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 informed her of the pending increase of $340 per week. Obviously, somewhat shocked by the news. Yada yada yada. That's real, folks. Like, that's what's happening in real estate at the moment. Like, that is just mind blowing as to, just how much that is for someone. I had to write back and say, look, I expect to lose the tenant because, she's not going to be able to afford it. But that's what's going on, and I'm calling it's basically property cannibalism. Like, it's just, she's gone. Next.
Next.
And that's what's happening out there. Like, real estate's carrying pricing power, and it's being shown in the rental returns right now.
Yeah, and really at the end of the day, the challenging part for most landlords is like, well, my costs are still rising, and this is whoever sort of said this one is just like, hey, listen, it's good we can put our rents up, but for most of us, it's actually not even close to covering the cost of the interest rates that have been passed through, and so for sure, I say to most people out there, listen, you might feel bad, but you're not a charity. You got to make sure you can cover your costs and make sure the cost of your investments taken care of and all of those sorts of things. But, really at the end of the day, I think that, to be honest, all three of us agree that I think that lands squarely in the government's lap when they did something. Sam, I'll circle around to this, and Andy, you could probably comment on this one. Sam and I were talking about this before. Something happened, folks. And listen, there is a market economist, a property market economist that we trust, probably the best in Australia, if not like totally the best, Dr. Andrew Wilson. He just calls it how it is, and the idea of, like, the CommBank, the ANZ Bank come out the other week, property prices to drop 25%. What a bunch of rubbish, The largest decrease in property prices occurred in 2018, since they've been tracking the proper data, Andrew Wilson. At the moment, it's 4.3 so far. Just, we've got a couple of months of 2023 under our belt. But, Sam, we were talking about what happened leading up to the worst reduction in property prices Australia's ever seen in general across the general market. And you had some info on this.
Well, yeah, it was government intervention. So you had the removal of foreign investors by virtue of, basically extreme taxes.
FIRB gone. Yeah,
overtaxing foreigners. Well, now, like, it's a prickly conversation because obviously sometimes when you think about foreigners buying here, you think about, well, it's pushing prices up, but also a lot of properties were produced which really locals wouldn't live in, produced and sold off to foreign investors that provided affordability to the rental market. So you removed a massive supply piece of basically shitty apartments in places close to universities, the Docklands of the like.
Shit houses in shit towns, Sam?
Shit houses in shit towns. It's a private joke, everyone. But yeah, it decimated. Then you had APRA, which put their speed limit on things and obviously remove investors from, providing housing to the marketplace. So, mate, triple whammy.
It was a triple whammy. And then the politicians, beating their chest going, if we get in, we'll remove negative gearing and we will remove capital gains tax if we get in. Vote us in.
We're experiencing the bullwhip effect of that now, aren't we, right? So, like, the decision made in, 2018, 19, call it, we're feeling the brunt of that right now. Where I'm literally talking to a property manager going, put the rent up $340 a week. I mean, that is pretty full on, right? Like, that is all because of those decisions back then. So
yeah, I totally. I've said this a heap of times, and I said it to Andy as well. It started a long time ago. This problem, folks, in real estate. COVID didn't do it. COVID was just like the kind of the last knock on the head, right? We already were leading into undersupply issues, Sam. Property quality issues, all sorts, like production. I mean, we were talking to developers who were like, I'm not going to, I'm not going to launch projects because, and
Well, we really haven't seen hyper supply since 2006, 7, 8, 9, when really we were doing deals where banks, liquidators, they were offering, 50 apartments, 40% off the purchase price. We haven't had hyper supply. Probably the last time the market was too oversupplied, maybe 2010, and then you started to get this natural recovery effect and sort of absorption. And by 2019, everything had been absorbed, and then they created policies to basically stop more production. So you had all stock absorbed, then a policy stop production. So, geez, man.
There we go. Well, Andy has to chuff off, folks. Mate, glad you could drop by, Fenton.
Thank you for having me on your show, gents. It's far more attractive with the two of you than when I'm on there. But Sammy, it's great to see you. I'd love to be on a couple of these where you come in and join us, because I always love hearing all of your stats. And
always up for it. But I think everyone loves you two at bantering. I think you got the secret sauce. So.
Well, mate, it's a good threesome. But next week I'll be coming back. I've been catching up with a lot of our fund managers, talking all things inflation, rate hikes, all of that sort of jazz. Very similar to the context of the conversation you guys are having right here. So, Sammy, it might be one that you want to chime in on, because I think that there's a lot of things that are lining up in equity markets which are really similar in your world. And Jace, mate, they've been saying pretty much the same things that you and I have been rabbiting on about probably for now about 6 months, and they're starting to jump on the bandwagon. So
mate, they're tuning in, mate. They're listening up now, I reckon.
I reckon they may well be. But lots to talk about around Reserve Bank action, Federal Reserve action, all of those sorts of things. So I'll look forward to sharing that with you guys next week and seeing everyone back there. But thanks for having me, and thanks for allowing me to pop in. Sammy, it's awesome to see you again, mate. And I guess from now, it's a good night from me.
And it's a good night from him already. But don't go away, folks.
I'll see you all next week.
All right.
Stay on. It's going to be gold with these lads.
See you, mate.
See you, mate.
Mate, good to have. He's coming back. Wait, I thought you were leaving. He's gone now. Well, mate, the idea that we've got a supply issue is only being exacerbated right now. You and I were talking about this something, and also circling around on Melbourne, right? Circling around the property market in Melbourne. We've got a huge amount of people, immigration, either students coming back or new people coming to the country because we've got a labor shortage. This stuff is going absolutely bonkers right now when it comes to, the number of people entering a market. And Melbourne, when we go back to those stats, Sam, was a little bit quieter than the other one. If we go back here, we go, right, Melbourne had, a harder time of it when it came to growth.
Melbourne's doing now as it's growth. Well, obviously everything reverts to its mean over the long term, and generally when a market's underperformed, obviously you can look at it and go, well, it underperformed, never buy there again. Or you could look at it and go, it underperformed, there's an opportunity.
Yeah.
It's got more room for capital improvement. And really the way we look at the Melbourne market at the moment is its underperformance is actually its opportunity, and growth will probably be rear-loaded in the cycle rather than front-loaded, whereas the other markets have had more basically front-loaded growth over the last couple of years. And really interesting enough, because I make a lot of my assumptions about markets by getting on the ground, not so much just relying on the data. So seeing what's for sale, understanding the geography of the marketplaces there, understanding markets in markets. And it's quite obvious there's a price disparity on what you can buy in Melbourne compared to other cities. And really that price disparity really at this point in the cycle shows a lot of value.
Yeah, yeah.
Interesting. Then Dr. Andrew Wilson, who's obviously opinion we kind of value, came out and put Melbourne as he's number one.
Mate, and I mean, the challenge over the years, I mean, you and I have chatted about this about Melbourne a gazillion times. You know, Melbourne often had a lower rental yield. It was always kind of like a percent behind, or,
Oh yeah, it's under-rented.
yeah, it's
got a
under
rent
rented.
cap. Yeah.
Yeah, yeah. And I think that's certainly on the radar to change sometime soon, folks, when it comes to, these markets. I don't know. I should turn this off. I'll do a little quiz. What's the most expensive city in Australia, capital city, to rent a house in, folks? Sammy, do you know? You know this one off the top of your head?
Oh,
Put
well,
that
mate,
in the chat. The most expensive city.
I hope you're not going to throw Darwin at me because I never looked at that place. I think I know. It's interesting. Like a couple of those cities, basically, it's considered unaffordable if you spend 30% of your gross income on rent. And some of those cities attract, because they're high income cities, they can actually attract above the national average on rent. So I don't know. Did anyone guess?
Yeah, there's a few people were going, Sydney, and it's not Sydney, folks. It's actually Canberra. And
Canberra people spend up to 34% of their gross income on rent. It's considered unaffordable at 30%. But obviously, I think people in Canberra make a lot of money, Jace.
Mate, well, they do have the highest incomes in Australia. I think the highest average incomes, isn't it? When you have a look right there, folks. The most recent stats. The average rental price in Canberra to rent a house is $690. It always blows me away. But check this out, Sam. And you and I just don't get this, right? So look at Melbourne. Look at the infrastructure of Melbourne. Yeah. And have a look at this. Darwin, Hobart,
I know.
Perth, Adelaide, Brisbane. Everywhere is more expensive than Melbourne. What?
I know. And it makes no sense because you couldn't re-emulate, I think it's something like 25,000 kilometers of tram line. You just couldn't re-emulate that in another city. No. It was built in, the start of the last century, and all that infrastructure you just can't replace anymore. It's irreplaceable infrastructure. But Melbourne's rent gap, which is basically, if you want to understand rent gap theory, you apply the affordability of what people are paying in rent to the national average, and the national average of what people pay of their rent at a gross level is 29% of their gross income goes to rent.
Yeah.
In Canberra, it's like 34%, and in Melbourne, it's 25%. So it's about 4% below the national average. But if you dig into a lot of suburbs, which drag down the mean, I found a suburb where it's 16% basically of household income goes to rent.
Wow.
So really what that tells me, that rent can actually double in value before it puts pressure on the household budget.
Yeah.
So a lot of Melbourne is fundamentally under-rented, and because obviously we see a lot of activity down there, and it's catching up though. The forecast is for Melbourne to sprint faster than the others from a rental perspective.
Yeah. I mean, otherwise known as the Dan Andrews issue. According.
Yes. Well, yeah, you lock a city down for a year and a half, and you're probably going to have a problem.
Hold it. Yeah, hold it back. And when you have a look at the world of apartments, well, Sydney certainly ranks up there as the number one expensive place to rent an apartment. But Canberra again comes in number two. But the house. So there you go, folks. At the end of the day, Sammy, we both know, being on the ground. This is the interesting thing. I always say, Sam, if someone says, there's this market issue. And I'm like, well, when was the last time that you went and stood in line at an open home or, saw how many people showed up to, an auction or whatever it is. And if you go and do that physical stuff, like you said, you get on the ground often, not just look at the data. And it's a totally different
world.
feel.
It's a
Yeah.
different world. Like
Yeah.
you're seeing it on, like, do yourself a favor, folks. Yeah, like go out to a sales open home over the weekend, go to a rental open home just for kicks and giggles, and you'll start to see what's going on. It's definitely people. There's not a lot of stock on the market for sale, that's for sure. People are holding on. People, and it's probably easy to see why. Like, if you were selling and you wanted to spend some time renting before you bought again, wow, like you can't get a rental, so you're not selling.
Yeah.
And then there's not a lot, so no one's selling. There's not a lot of stock to go, well, I'll sell and buy. So the market's grinding to a bit of a hole.
It's jamming itself, Sam. It's stuck, right? Like it's like
Completely stuck. There's not enough stock on the market.
Oh, well, I mean, leading right into that, I'm glad that segue worked out for me. But here's the stock change. I mean, and again, to dine out a little bit on Melbourne, but sort of Melbourne and Sydney, the reduction in not only sort of yearly change, monthly change. Have a look at that. The number of new listings for sale, like the interest rates going up, people aren't bailing on their homes. Like this idea of this mortgage cliff coming, people are going to leave and whatever. I think that's a bunch of bullshit. Like technically, well, economically, they can't, even if they were to bail out, where they're going to go, the rent's going to cost them more than their mortgage sometimes, So, it's actually causing, what I find funny, not funny, but a fucking crazy, Sags. Like there's no commentary on the dire supply issues in the media. Like, we're talking about, like, let's have a quick look at one little article.
Well, they tend to look at approvals, and as we know, approvals don't equal anything. Like an approval is nothing. It's got to get off the ground. It's got to be feasible. It's got to mathematically work out. So I tend to see from media like, approvals which are down, but approvals is not actually, handovers when it comes to supply.
No, and arguably, Sam, like, we know many of the best, producers of great quality property in Australia. I mean, fucking all of them. I mean, you've been doing this for 25 years, you know them all. And, they're not saying, oh, Sam, it's the easiest time ever to deliver a piece of real estate. Like they're saying it's the hardest time I've ever had to deliver real estate on price and on budget on time.
It's a nightmare. I caught up with one notable developer. He sits in the BRW top sort of 200, and basically his pipeline of stock is now so far backlogged that it's a real pickle. Like they just can't get stock onto the market quick enough because there's just so many moving parts. There's construction, government, sustainability constraints. There's
employment, like you got
employment. Like, mate, it's that you can't get the trades to build the stuff.
You can't get it, and like talk about Melbourne. For example, Brisbane. The largest public infrastructure project ever in Australia's history is underway in Melbourne, right? That's got nothing to do with real estate. They're digging tunnels and they're pushing, trams around. We've won the Olympics in Brisbane. Folks, we've got to deliver all this infrastructure. That's got nothing to do with housing.
Did you see Cleanaway, which is basically a garbage business? The managers are driving the garbage trucks.
like Matt.
There's no one left.
There's no one to fucking do the work.
There's no one to do the work. It's unbelievable. So, like, that's a huge company. That's one of the biggest. Basically, they deal with all sorts of waste, construction waste, recycling, like literally managers are becoming drivers because, yeah. So I don't know, like, call me a simpleton, but when we talk about sort of things slowing down, recession, whatever, like I just don't see it. There's just too much work. Like if people got work, and there's too much work, like it's just, things are just the new normal. Like we're just living with, a cash rate, which, yeah, probably settling in at where we're at now.
Well, yeah, I mean, let's talk about that for a second. Let's talk about that cash rate. I mean, both you and I aren't Andy Fenton by any stretch of the imagination, but let's, the cash rate. There's a beat up. Oh, it's up wherever. Well, like in reality, folks, we're already seeing where the cash rate's going to end up. I mean, you can beat it up till the cows come home. But Sam, one of the great things that Andy, has talked to me about, folks, and you guys know this, we talk about the aggregated opinion of people far smarter than us when it comes to the world of this idea. And, where does it look like? Let's have a bit of a sticky beak here. The Australian 10-year government bond, folks, really is the predictor. A 10-year government bond of where the cash rate, is predicted to be. So, you can see this range between sort of 3.5% and 4%. But, in reality right now, the market's pricing at Sammy at 3.8. A little while ago when things were a bit slower, maybe 3.3. So, we've been talking about 3.5 to 3.75 cash rate for well over 12 months. Like it made sense that that's where it would get to. It made sense that that's where it would need to be. And folks, and I don't say it flippantly, Sammy, anyone listening in, that, interest rates at 6% are just what it should be, right? That's really the normal cost of money. Anywhere between sort of 5 and 6%, you've got a normal cost of money which is quite healthy for the system that it's in. Things can flow. So really, at the end of the day, we know we're going to end up with a cost of money at around about 5 to 6%, depending on the risk and the LVR. But there's already talk, which is talking about America's already dialing back their stuff, and also, Australia's, tipped to be one of the first ones to cut rates sometime in the future, big question mark on that one. But as property investors, Sam, nothing we can do about the cash rate, right? There's nothing you or me or anyone listening in can do about that. But what else is driving? You were talking to me about the FIRBs, the FIRB. Maybe jump in on that one and have a bit of a dine out on what's going on.
I think Andy kind of summed it up. China's kind of going through some problems. Like you've got obviously a depopulation situation occurring, and you've got obviously over there they've got some real challenges with their housing market where they've basically created hyper-supply. They hyper-supplied their own market with ghost cities, basically based on an increased level of population, and the place is falling to bits, really. Well,
I mean, did you hear the Japanese Prime Minister, Sam, issued a national disaster thing, said, hey, listen, we in 20 years, we'll be a third world country if we don't have some more people.
Have some more people. Well, and you know what? I mean, this is the advantage of Australia's immigration system, because when you think about someone being born, perhaps to age 25, there is no production value of that person. In fact, it's a cost.
It's a cost, yeah.
It's a cost to basically GDP. So the idea of going and then asking people to come to your country who are already past that age, but are in their highest sort
earning
of
and tax paying, plus
bringing skill, it's actually a bit of a masterstroke. Like, and it's going to get tougher because the whole world's onto it. I think I mentioned, like in Hungary, if you have 4 kids, you don't pay income tax.
Well, fair enough. I think that'd be a great rule, Sags. Sonia's going, don't they cost money, those little buggers? Yeah, fucking oath they do, Sonia.
So imagine that, a society where if you had one for the country, instead of paying 30%, you're paying 25%, and then 2, you're paying. So, you'd be tax-free by now, Jace.
I'd be living the dream.
So some countries are going, geez, we better, and the problem for Hungary, of course, is they're going to do that, sponsor families to have children, not pay income tax, and then Australia's going to pinch them all.
Yeah, well, because there'll be no opportunity there for jobs. That's
So we're kind of blessed in the context of we have a pretty smart, skilled migration dynamic, and that's where we see today, really Australia as a Anglo-Indian Asian fusion of skill, and it's very different to other places, and for China in particular. Like if you're Chinese and you're in the sort of middle class with a bit of money, you're not investing in Chinese property.
No.
It's not going to happen. So you're looking for a home. So I'm starting to see all these articles. Like I'll just do a quick share, but I mean, like there's a lot of articles of.
You need to share your screen again.
A lot of articles of just overseas investors, Chinese residential real estate investment, Australia soars 67%. You've got foreign buyers return, dream home sales to Chinese buyer, Chinese investors set to spend $5 billion this year in Australian property. So it's happening. Like we talk about the migration of money in simple terms.
Locally in Australia. Yeah,
but there's a migration of global money. Australia is a safe haven, and we're going to start to see a lot of that because the dollar is quite competitive to move money. The tax is what it is, but it's actually for a lot of overseas people now, with their kids coming here to learn. There's going to be a bit of a power back, I think, of that money coming into the economy.
You and I know, anecdotally, only because we've got business interests in residential real estate and property management. Conversation the other day, one of our property sales team up in Brisbane, the student couldn't find an appropriate place to live, so the parent sent them $1 million and they bought an apartment.
Yeah,
that's what happened.
which kind of blows our mind, It's just like, that's just, But there's obviously a lot of money around the world, and it's always looking for a safe place to be parked. And here in Australia, it's typically been a bit of a safe haven over the years for certainly, investors who live in Asian countries, particularly China. They're always trying to sort of move their money out and safe haven it here.
Yeah, I mean, we're very stable as a country politically. We're very stable with our banking system, top 3 in the world. And at the end of the day, we've got a history of immigration successfully working for Australia. It's been, right from the outset. There you go. Well, Sammy, why don't we, we're moving to a close, but why don't we do one of our little segments called the Number One Menace? I've got something here. Maybe you and I can riff on it for a few minutes.
Let's do it. I've never done the menace.
All right, what do we got? Hey, listen, folks, Number One Menace. Well, Number One Menace, like, the other day I heard this one, which was good. Actually, Owen came up the other day, and it was the combination of the Number One Menace. Put it in the chat for me. You got the government, you've got the media, and you've got the banks. BMG. They're the 3 that can cause, plenty of grief when it comes to you and your wealth. Check this out. How to lose $1.26 billion, folks, in the blink of an eyelid. Now, I'm not condoning, nor do I support gambling in any way, shape, or form, just so we're all clear. But check this out. The New South Wales government, Sam, we all know the story, got in a bit of a stoush with, the casino group and, decided that they were going to teach them a lesson. This is how I see it, folks. Anyway, so then the government says, you know what? We're going to increase our tax on the Star and the Crown Casino Group, right? That's what they said. What happened? They said, all right, we're going to increase our tax. We're going to put our taxes up, a couple of percent, on average 2%. What did that do? This actually interests me. They're going to say, all right, well, we're going to increase our revenue that we get from the casinos, 364 million. And check this out, Sam. And what they're going to do with that 364 million, folks, is they're going to have 33 million of it go to responsible gambling and 5 million go to another fund. And that's it. Sam, where did the other 300 million go?
Wow.
What? Like, did anybody just see that? They're like, abracadabra. All right, there we go. So there you go, folks. There's balance sheet maneuver 101. When it comes, we'll just put the taxes up. Boom, gotcha. Right. So anyway, the point is, folks. That is creative accounting, Alison. Right. And in plain sight too. So they said, we're going to raise $360 million worth of revenue, but we're going to spend $38 million over here. And everyone goes, oh, great idea. Fabulous. Nobody had a revolution on that. Anyway, so there you go. Number one menace at work. But this one is probably more prevalent, Sam. Trusts. Company and trust structures have been around since time immemorial. They were invented back in the olden days, back in the knights' days, back in, the common law from England and so on. Anyway, just only a little while ago, the ATO decides that they think they're tax evasion schemes and they're going to investigate them. It doesn't matter. Doesn't matter. We've been using them for fucking 200 years, or probably thousands of years if you go back to England. They're going to have a look at anti-avoidance and tax avoidance, folks. So there you go. I think it's a scare campaign. We've had a chat to our accountants, and they've sort of said, listen, there is a 0.01% of a 0.1% chance that there could be something here, but just keep an eye on it, folks. This is creative. Yeah, I wonder. Yeah, exactly. If they look at themselves. And the other one, Sam, I saw today. How's this? The language around super. I saw Albanese interviewed, and he said, listen, folks, super is meant as, something that can help the economy not pay for people in retirement. And hang on, it's like, hang on, no, super is like he was saying, it's meant for the government not to have a burden. And it's like, and they're lining up to tax it. Like, okay, here's my call.
Okay, yeah. It's actually not our money, according to.
It's not our money. He basically said it's not your money. Like, what are you thinking of? What are you talking about? It's for the government, so you're not gonna. So we don't have to pay you so much in pension. And he's like, we're thinking we might change the rules. And I'm like, fuck, did anyone just hear that? Like, holy moly.
Wow.
Yeah.
I say there's always four horsemen. You've got the Reserve Bank, you've got banks, you've got certainly the regulators like APRA, and then you got the government, and they're the ones that cause the most grief with this thing called investing. If they would, if not one of them is meddling, they're all meddling.
They're all meddling. Yeah. Well, listen, mate. I think we might call it done and dusted, folks. Mate, that went a lot faster than I thought. I quite enjoying hanging out with you today, doubling down on the property world.
Yeah. Well, mate, happy birthday for the weekend.
Appreciate it.
You old man. The big 5-0.
Mate, how far are you behind? You're only 5 years behind, aren't you?
I know. The weird thing is, like, I don't know, like 70 years ago, we would have about 8 years to go. Do you know what I mean? Like, I think superannuation or the pension began in like 1895, and they made the life expectancy to get the pension 65, but the pension was at 65, but the life expectancy was 58.
58, yeah. It's like they're not going to get it, so that's okay.
Oh, well, awesome, mate. No,
Mate, I only feel like we're just getting started. Halfway there, Sags. Well, mate, great to have you on the show.
yeah.
Give Sam a bit of a shout out, folks. Thanks for joining us,
No
Sags.
worries. No
Love
worries.
to have
We'll
you back
Andy
again.
next week.
Yep. All right, we're done and dusted, folks. Thanks for hanging out, and thanks for the birthday wishes. I'll send you some photos, and away we go. All right, mate. Well, that's it. We're done. Dusted.
All right.
All right, folks. Adios.
See you,
Great to
folks.
see ya.
Bye.
Bye-bye.
Thanks for watching another episode of Wealth, Wine and Wisdom.
Make sure you like, subscribe, and turn on the notifications so you never miss a thing, folks.
We'll look forward to seeing you next time.
Debrief the week with Wealth, Wine and Wisdom.
Every Friday at 5 p.m. Victoria and New South Wales time. We know that Queensland, South Australia, WA have different time zones, as does Darwin, but we're sure that you can do the calculations, depending on whether it's daylight savings or not.
You can also catch up on all the episodes wherever you get your podcasts. Make sure you check out the Positive Mentor podcast from our 6-star team at positivementor.com.au.